Hello and welcome to week 4. This is the first and the last week for accounting. Let's go into the accounting section. Okay, now if you notice in the accounting section, there's a lot there. It seems to be repetitive. I'll try to clean that up a little bit. But what it is you have the PowerPoints and the notes. The PDF is the notes, which also includes the PowerPoint. Okay. And there's just chapter 1 and 2. That's all we have to worry about. So they're very, very long, and I'm going to do my best to cover a few of them from each of the chapters. But this is something that you're going to have to spend the time on to go over. I had to condense one of the topics down to 1 week so that there would be time to get everything in the 8 weeks. I chose accounting because you're going to be taking accounting courses that'll go to a lot more in depth than what I'm going to be doing. And so I'm just trying to do an introduction to it and allow the CPAs and people with the doctorates in accounting or experience in accounting uh, teach you the correct way of actually practicing accounting, actually doing it. So I'm just going to go through this as a cursory type of um, introduction on the importance of accounting and things like that. Okay. Otherwise, you'll be asleep probably in 20 seconds, and might not get anything out of it anyway. Let's see if we can cover some basic points in this. Okay. So accounting, you identify, recording, and communicating. For example, the sale of an Apple by Apple of an iPhone. So you identify that the sale is happening. You record it, keeping chronological log of the transaction, and then you prepare reports such as financial statements based on that. Excuse me. User financial information, external users or lenders, shareholders, governments. Um, excuse me, I think I'm going to sneeze. Consumer. Excuse me. And then internal is officers, managers, internal auditors, sales staff, budget officers. Okay. Where's my cursor here? Ethics, key concept. The goal of accounting is to provide useful information for decisions. Uh, Information to use that must be trusted. There's a video that I've posted for you to watch about the fall of Enron and Arthur Anderson, who is no more as far as the company goes, was a key player in the fraud at Enron. Arthur Anderson was an accounting firm, one of the big 8 back when it was a big 8. And so I hope that's an interesting video for you to watch. But an accounting firm is supposed to identify ethical concerns, analyze the options, and make ethical decisions. Fraud triangle, financial pressures, opportunity, and rationalization. So, financial pressures, you have to make the goals of the company. You have the opportunity because you have access to it to create false statements, false financial statements, or to alter things so that they're more favorable. And you rationalize them saying that, well, everybody does it anyway, and nobody ever goes to prison anyway. And so it goes on and on. In fact, at the end, if you watch the Enron video, excuse me, the head of Enron had a practice of firing 10% or more of the employees every year that didn't perform up to the standards that were set. So that creates an enormous financial pressure, which then is one of the triggers for a fraud triangle. Okay. Um, Jack Welch at General Electric also did that, fired the bottom 10% every year, again creating financial pressure, which could lead to fraud. Which created Sarbanes-Oxley, and I have an article for you to read on Sarbanes-Oxley attached to this week. General Accepted Accounting Principles, or GAAP. These are the rules of how accounting works. The principles, the measurement principle or cost principle, accounting information is based on Actual costs. Actual costs is considered objective, not subjective, because if something costs $5, it costs $5. Although Enron did find a way to make it subjective instead of objective, but it's supposed to be objective. Revenue recognition principle, recognize revenue when it is earned. Again, Enron found a way around that as well. Proceeds not to be in cash. Proceeds need not be in cash. They can be in other forms. And then measure revenue by cash received plus cash value of items received. Expense recognition principle or matching principle, a company must record its expenses incurred to generate the revenue reported. So if you're a delivery driver, you incur expensive gasoline, and so you would incur it while you're trying to deliver the products. Okay. Full disclosure principle, companies required to report the details behind financial statements that would impact the user decisions. J.C. Penney declaring bankruptcy yesterday. They should have made it known that that's what they were intending on doing prior to yesterday, because when they made the interest payment yesterday, people started buying their stock and it jumped 14 or 17% or something like that. And then they declared bankruptcy, so all the people that had bought the stock lost all their money that they had invested in JCPenney stock. Accounting assumptions, going concern assumption reflects assumption that the business will continue to operate instead of being closed or sold. Again, JCPenney's. Monetary unit assumption, express transaction event to monetary or money units. In other words, everything has to be translated into a monetary unit. Business entity assumption, business is accounted for separately for other businesses entities, including its owner. And time period assumption, presuming that the life of a company can be divided into time periods such as months and years. Okay. Accounting constraints. Materially only if information that would be influence decision be reasonable, person needs to disclose. Costs, benefit, only information with benefits of disclosing greater than their costs need to be disclosed. Okay, and now we've only made it to 10 and there's 57 slides. So I would recommend you going back and reviewing the other 47 slides on your own. I want to touch on the second chapter because we're doing both today and you have a test this weekend on both. So we have managerial accounting. Managerial accounting provides financial and non-financial information for managers of an organization and other decision makers. For purpose, managerial accounting, monitoring and feedback. So planning, strategic aims, long and short term, annual budgets and control, measurements, evaluations, and oversight. For example, right now, all the companies, publicly traded companies especially, reviewed their finances to see if they had enough cash to last the rest of this year if they had no more business. So the airlines did this. I forget which one said they had enough cash to last the rest of the year, even if they didn't fly one more plane that year. Ford and General Motors came out and said they had enough cash to last for the rest of the year, even if sales completely tanked, which they did. They went from over 16 million annualized last April to 8.2 million annualized. This year, annualized means you take the sales for the month and multiply it times 12. So they didn't sell 8.2 million cars last month. They sold 8.2 million divided by 12. And last year they didn't sell 16 million plus cars. They sold 16 million plus divided by 12. But it's always reported as an annualized basis so that you can see how many sales they're actually having if it was for the whole year. Okay. I'm almost out of time. Nature of managerial accounting. So you have the user, the purpose of the information, flexible of reporting, timeliness, time dimension, focus of information, and nature of the information. And then you have the financial accounting and managerial accounting. And it looks at each of those different accountings, forms of accounting, and tells you what they look for in each of those different areas. So, for example, the focus of information for financial is the whole organization. Here, for focus of information, the whole organization for financial, and an organization's projects, processes, and divisions as far as managerial is concerned. So each one has a different focus depending on what you're doing. Fraud and ethics in managerial accounting. Fraud affects all businesses and is costly. A 2014 report to the nation from Association of Certified Fraud Examiners (ACFE) estimates the average U.S. business loses 5% of its annual revenue to fraud. Now, one thing I did hear this past week was something called a shadow company or a zombie company. I heard both terms being used. Um, shadow company was used more towards companies that were created just to get the government bailout money, and the company actually never existed. Whereas a zombie company is a company that's being kept alive on paper, even though everything's shut down, just to keep, just to get help from the government, and the owner may or may not have any intentions of opening up again. They may intend to open up again, but they may not be able to if the business doesn't return or if they don't have enough funds. If you're talking about a restaurant, then all the food has to be destroyed because obviously you can't have old food. If you're talking about clothing, well, if it's out of season, then it's not going to sell. So you have to get rid of it somehow, sell it to um, Ross or TJ Maxx or someplace that buys bulk and get 10 cents on the dollar if you're lucky, maybe 5 cents on the dollar. So many of the businesses that are closed can't just reopen because they have to restock everything and they've just lost all their money on the stock that they had in the store. So they're saying that there could be a lot of zombie companies out there that are still in existence technically and getting government help, but they may never reopen, or if they do reopen, it may be only for a very short time and then shut down again. Then cost of clarification, the types of cost classification, classification of behavior. Total fixed costs do not change when activity changes. So your rent is your rent. It doesn't change. Now it might go up once a year, but from month to month, it stays the same. Okay, if you have all salaried employees, then your payroll doesn't change. It's the same month to month. And again, you may give a raise, but normally it stays the same month to month. Variable costs change in proportion to activity changes. So if you're a factory and you're running on your machines, your electric bill is $1 amount. Right now, if your factory is shut down, you're not running any machines, your electric bill is far less because you're not using electric. So therefore, your variable cost for electric is much less. The last one we're going to look at is the graph for fixed costs, the graph for variable costs, and then the mixed costs, putting them together. And that's all we have time for right now. Don't forget that your test is this weekend, and I would strongly suggest you go over these 74 uh, slides along with chapter 1's 57 slides and watch the videos and read the article that's posted for you on this week. So if we go back to week 4, you can see the biggest fraud in history, SOX, which is Sarbanes-Oxley, internal audit control article, and then don't forget your discussion board entries as well. Thanks a lot. I hope you have a great week.